we've said that the demand for money shouldn't depend negatively on interest rates in the general money market. But what about demand and supply in the overnight market or the federal funds market specifically for base money bank reserves? Well, we can argue that that does depend negatively on a nominal interest rate, specifically the policy rate. Much of the money base, of course, is not interest bearing. Even for that part of the base which is interest bearing, commercial bank deposits at the central bank, the interest rate is simply fixed by the central bank itself. The central bank also arbitrarily fixes the rate at which they lend to commercial banks. They fix the band between this rate and the central bank deposit rate, and they can actually make the policy rate come in somewhere between the narrow band between the bank rate and the central bank deposit rate. In fact, wherever the central bank wants it to be. In Canada, basically they do the requisite number of drawdowns and redeposits at the end of the day, and the policy rate always winds up exactly where they want to be. So I think it's entirely legitimate to assert horizontalism in the overnight market, i.e. the central bank sets the policy rate wherever it wants to be, it's reasonable to assert there's a downward sloping demand function for reserves for the reason that we've mentioned. And so it works in the overnight market. The question is how to translate that into the broader money market. Okay, so what would be the natural economist way for working out these issues? Well, you would try to work out the demand for and supply of commercial bank deposits. We've already put down an equation for the demand for commercial bank deposits. The supply of commercial bank deposits we've also kind of explored a little bit, for example, in the widget example. So we've already written down the demand side for money demand. I've now put the price level on the right-hand side. So the demand for nominal bank deposits, the demand to hold bank deposits is some fraction of current nominal GDP. Now remember how we told the story about the money supply being endogenous. We actually allowed the entrepreneurs to borrow the wage bill. I've just put a simple version of this here in equation 11. We've suggested that the entrepreneurs have borrowed the wage bill. Actually, they have to borrow the wage bill and more, as we will see. This phi term has to be greater than 1, and that is to solve that realization problem that we talked about previously. But here we imagine like a one-period production period. The entrepreneurs borrow the wage bill. That creates the money supply. It has to, because of the time period of production, they have to hang on to that money at least for one period. And so the supply side, MS, the supply of endogenous money, is equation 11. This is the kind of equation, of course, one sees in circuit theory, modern money theory, and all of those heterodox schools. Again, to stress the point we were stressing the other day, it's important for the viability of both the banking and the industrial system that this term phi be greater than 1. That's a way to handle the realization problem in the current context. I mean, basically, there has to be more M prime once again. And the way that we've done it, or the way that we've argued it, is that, as you probably know, the circuit theorists such as Graziani have argued at the macro level, all the wage bill must be borrowed. Of course, an individual firm thinks it is only borrowing a portion of the wage bill, but if you aggregate the entire firm section, the circuit theory argument is all the wage bill must be borrowed. That's proved by aggregating the private sector. And I can simply add that other types of borrowing, for example, consumer borrowing or even mere financial speculation will also be conditional on some measure of income, such as the wage bill. I mean, if I go to my bank and want money to speculate on the stock market, they are certainly going to ask the question, what is your rather meager annual income? And so therefore we make this, so therefore I think we can say that this coefficient is typically greater than 1, and in the context of this model, as opposed to the one that we were looking at yesterday, that solves the requirement for money profits to be positive. So here we are, the market for bank deposits, money demand, the demand for a stock of money at a point in time equals the endogenous supply of money. We have expressions for both money demand and money supply. We've said that production takes time, so I'm just making that explicit. You know, labor input is put in period -1 when the wage bill is borrowed. A is the average productivity of labor, and Y is the resultant GDP sold in the next period. Taking logs of 13, rearranging, subtracting the log of the price level from both sides. Remember, the inflation rate is approximately equal to the log of the price level minus the log of the lagged price level. We basically come up with this expression, which, if you remember, was the third equation in the alternative monetary model. The inflation rate, it's interesting, notice we're deriving it from the financial markets, and yet there are cost push, elements in it. It obviously depends on a cost push element. In this case, whether the lagged real wage was greater than productivity. That's one source of inflation. The other source of inflation is this P0 term. If P0 goes up, the inflation rate goes up. If P0 goes down, the inflation rate goes down. Well, what is P0? Obviously, it measures the state of liquidity preference. So we're taking into account both sides of the money and the financial markets. And basically, that P0 term measures the state of liquidity preference. When liquidity preference rises, when there's bearishness in the financial markets, P0 goes down, okay, and vice versa. When there's bullishness in the financial markets, P0 goes up. Don't forget that modern quantitative easing is also a question of buying and selling bonds. And we could also, if we wanted to, interpret the modern quantitative easing in those terms. Quantitative easing, which has come into the vocabulary recently, is meant to bring about an increase in P0 through its impact on the log of phi term.
Yeah. Could you go back to the market demand and supply of money?
Yeah. I hope.
This one.
This one. Yeah.
Next one.
The one back.
Yeah.
Yeah.
The back for demand for money and supply for money.
Oh.
You use.
Sure.
Here.
Yeah, that's what. Yeah.
So in this term, I think it is a narrow definition of borrowing. The loan is only for the purpose of wage. But if we do not consider what kind of purpose has been used for the loan, we can generalize to the borrowing flow. This is a relationship between flow and stock.
Yeah, well, what I was doing here was just taking the standard circuit theory view that the whole of the wage bill is borrowed. If you get that problem, the problem is, where do interest rates payment come from? This is a classic circuit theory problem. Also, you would get the problem that we were going through yesterday. Where are the money profits coming from? And so all I've done is I've just said, this, by the way, goes back to Basil Moore in Horizontalist and Verticalist. Basil was the first one to say that this phi term should be greater than 1, and he, in my opinion, absolutely right. And what I'm trying to interpret that is, yes, in aggregate, we're borrowing the whole wage bill. Other types of borrowing, consumer borrowing, just borrowing for speculation, is also conditional on, when you go to a bank to borrow, they will ask you what your income is. And that wage bill then presumably is a good proxy for, aggregate income. And if there's going to be more speculation, for example, which in a certain sense means less liquidity preference, then again that theta term is going to go up. And of course it's going to affect the P0, because remember P0 consists of the, of the two terms. Go back to equation 5 in the original AMM. And you'll now perhaps realize that why we did want to introduce the whole AMM to begin with, even though the different equations were not perhaps entirely clear where they all came from. But one of the things I asserted is that there should be a negative relationship between real interest rates and inflation, not a positive one. And it's a rather simple argument, actually. We have a nominal interest rate equation. The 2 points in there are M1 is the pass-through coefficient from the policy rate to the interest rate in general. M0 is the markup of the commercial banks, the markup between commercial bank lending rates and deposit rates. And I just subtract the inflation rate from both sides of the equation. I'm taking your advice about realism. And we get a negative relationship between real interest rates and inflation. Historically, this was known as the forced savings effect. It was something that Hayek didn't want there to be. In the 20th century, this same idea was called the Mundell-Tobin effect, after Mundell and Tobin. What we've done here is shown its existence in a fairly simple way. I don't see how there can be argument about that particular way of showing it. So in terms of the real rate of interest now, presumably if the model does converge to equilibrium, there would be an equilibrium log of the real wage, so that W would be equal to W lagged equals W lagged twice, and so forth. And if you think about it, we then get a simple two-equation model of the determination of real interest rates. There's equation 21, that mixed cost push and financial markets equation describing inflation. There's the equation describing real interest rates. If we then solve for the real interest rate, I've done it here, you can see the various factors which affect the real interest rate. Liquidity preference is one of them. And it works exactly as Keynes said. If P0 falls, there's an increase in liquidity preference, real interest rates go up. Obviously, the central bank, here I'm nodding towards the horizontalists. Yes, it's true that the central bank setting of the real interest rate has an effect on interest rates in general. If the central bank increases its real policy rate, real interest rates in the marketplace will also rise. Not necessarily one for one, but by these pass-through coefficient, which empirically typically is about 0.8 or something like that. What else affects interest rates? Well, wages do. An increase in real wages reduces real interest rates. So, yeah, this is a fight over income distribution to some extent. Again, if we have an increase in productivity due to innovation, that is going to increase real interest rates. And that sounds almost something like a neoclassical would say, the marginal productivity is increased. But again, it's not working that way. It's working through the fact that if we have an increase in productivity, one of the side effects of an increase in productivity is a reduction in the inflation rate, the so-called new economy scenario. Growth goes up, inflation goes down. That's why the real interest rate changes in this particular model. And then finally, we'll just end with you can graph it to graph the monetary determination of the real rate of interest, real interest on the vertical axis, inflation on the other axis. We have this straight line in this particular case, which describes inflation. We have this downward sloping line, which is the negative relationship between real interest rates and inflation. And obviously you can shift the curves about as you will to determine the thing. One of the important things I think here is we've reintroduced liquidity preference, not precisely in the form that Keynes had, but the liquidity preference is now consistent with works in the case of endogenous money. And that is a big issue, at least it's a big issue amongst the various heterodox schools of monetary thought.
So you had in your model a rate that pops out after all the argument is done, and it depends on the equilibrium wages and the productivity. So if we call that the Smithin rate of interest, there is an argument there that if the real rate is higher than that, then stuff is going to be contraction, and if it's lower than that, you said yourself there's going to be inflation.
I'm not denying at all, and this is where we have agreement is the wrong word with the neoclassical groups and so forth. There certainly has to be attention paid to monetary policy, and there certainly has to be interest rate rules of the type that Woodford and Taylor and so forth would introduce. My only 2 points about the Woodford rule. First of all, you go through all the micro foundations in a Woodford type model, and when you get to the end of the day, what do you have to do? You have to add an interest rate rule with no micro foundations. But then, obviously, the idea of that, yes, is certainly that if you raise interest rates, you'll reduce inflation, for sure. That works in this model too, okay? It's just that there are no natural rates of any of these things, right? There's no equilibrium to which these things are returning. There's an equilibrium in the mathematical sense, in the steady state sense. And certainly, in a certain sense, central bankers wouldn't be doing anything different if they're following my rule than they do now. As a matter of fact, they would actually be more active in recent times than they have been. So, I mean, I fully accept that. There's elements of Vixellianism in there. What there is not is the absolute block that's in Vixellianism of the this natural rate of interest. But otherwise, the logic certainly continues. So I just want to, yesterday we also had lots of talk about, different theories of value and different theories of income distribution. So I think it's incumbent that we distinguish between the neoclassical theory of utility, classical theory of the labor theory of value. I would prefer a theory which Jeff Ingham calls a social theory of value. I've often asked Jeff Ingham what he actually means by social theory of value. Here's the point that I want to make. In this subject of monetary macroeconomics, it's important to note that profit is not the same thing as interest rate. It's important to distinguish between the real rate of interest on money and the profitability of business enterprise. The former is a monetary phenomena. Notice we're saying the real rate of interest is a monetary phenomena, right? gets back to the awkwardness of the language that Matthias was referring to, as claimed by Keynes, whereas the latter is in the nature of a surplus over and above the cost of production, including finance costs. And therefore, what I'm asserting, and I think can be shown, is there must be an inverse relationship between the real rate of interest and the average profit or markup share. So what we'll just do, I don't want to go through all that discussion that we had yesterday about Marx and the Neoclassicals. What I will just do is try to put in a synthetic theory of profit and of the functional distribution of income to illustrate these points, particularly this point about the inverse relationship between interest rates and profit. You can actually derive a synthetic theory of profit from just two fairly simple equations. Number two we'll look at first is just our old idea that production takes time, that the GDP that is produced this period depends on the labor inputs of the previous period. And the number one is a value equation in nominal terms. You know, the nominal value of the output in the current period is P times Y. And how is that split up? How is that divided? Well, the first term on the left-hand side is pi, profits, surplus value. This is again in money terms entirely. Obviously, one of the main costs was the wage bill. And presumably, if the wage bill is paid at the beginning of the period, there has to be an interest cost on the wage bill, 1 plus I minus 1. What's this final term on the other side? Well, I think of U as being somewhat similar to Keynes' user cost, or perhaps to Marx's constant capital, which means the raw materials and the capital used up, okay, during the process. And so therefore, obviously, if we take these two equations and use these definitions, we can reduce our equation to a fairly simple markup equation. The nominal value of the output is equal to two markups. There's a big complicated markup, 1 plus pi prime plus k prime. In short, that markup is accounting for the rate of surplus value, and it's also accounting for the organic composition of capital. There has to be an interest charge on both. The wage bill, of course, is the prime element of costs. And then our K, which we've been using up to now, is in fact, I would call it the gross profit share or the gross markup in that sense. K is equal to pi prime plus k prime. And so the whole thing reduces to something we've already seen, which is P times Y equals 1 plus K times 1 plus I lagged times the lagged wage bill. And then obviously it's just a question of reducing the thing to a simple adding up theory, taking logs, subtracting the log of the price level from both sides. And we come up with our distribution equation where K is this aggregate profit markup, which now includes an allowance for depreciation, if you want to put it that way. A, of course, is what there is. It's the average of labor productivity. The reason we have lagged R minus 1 and lagged real wage is because of the structure of production. And so that's the basic theory of income distribution. And the diagram doesn't add very much because these are all straight lines. I just want to point out that it's true that so in other words, I've just drawn the real wage as a straight line, interest as a straight line, productivity, given state of technology, is a straight line. If the interest rate goes up with no change in productivity, no change in wages, it must cut into the profit share. So I think I'm going to leave it there, and you're going to do some simulations of these things now in the complete AMM. So I'll turn it over to Fredrick.